Alright, so some of you may know me as a Signal King, some of you may know me as FX Jordan G. And I've been trading for over 7 years now, and that's over half a decade, which is insane. Now, thanks to me sticking to my plan and not giving up, I'm able to make results on the low end anywhere from a few thousand a day to on the big end anywhere from like $15,000 to $20,000 on one single trade. Now, what I give credit to for these results and to be able to make this type of money is definitely the sniper entries that I get in the market. I use sell limits and buy limits, sometimes entering and having the position ready an hour, 2 hours before it even goes to that area of interest that we're going to sell or buy from. I have an exact method to get these entries and I'm going to show you guys. Now, it's a simple step by step, but if you follow them, it's proven to get the most sniper entries in the market. I can guarantee you there's no other strategy out there that they get these sniper entries. Now, to get these sniper entries, you guys got to know that it all starts on the higher time frames. It doesn't matter if we use the M1, the M5 to get our entries, even the M15. It all starts on the weekly, the daily, the H4, and the H1, letting us know where the market is going to go on a higher time frame. For example, we got to know where the market's going to be able to identify our target. Once the target is identified, then we can go on the lower time frames and see if price is in alignment with the higher time frames. So if we're looking for sells on the higher time frame and on the lower time frame price creates an area of supply that is in alignment, we could sell. But if we're looking to sell and price is creating an area of demand, why would we buy? If that makes sense. So the lower and the higher time frames have to be in sync, and once they are, we just execute. Now, let me show you guys. It all starts with the top-down analysis. So the first thing that I do, guys, and I'm gonna give you guys some sauce here. So I'm gonna show you. We're gonna go to the M5 time frame, and I'm gonna show you if we're trading here on Monday, we're gonna mark our high and low of day coming from one previous trading day, which is gonna be from Friday. It's not Sunday because Sunday is not a trading day. Now, it's gonna be the highest and lowest point from Frankfurt to New York session. Asia session does not count, and it cannot be the highest point of the literal day. It has to be a point in session. So this is the highest point in session, so that is the high of day. Now we're going to mark the low of day, which is going to be this point right here, low of day. Now pay attention, guys. Now we go to previous trading days. So if we're trading on Monday, doesn't matter if we're trading London session or if we're trading New York session, is 2 previous days. We're going to go ahead to Thursday, 2 previous trading days. Now, same rule, it's the highest and lowest point between Frankfurt to New York session. We're gonna go ahead and mark this right here as the previous low of day, previous low of day. And you guys are probably asking yourselves, why are we starting with this? And I will show you why this is key to get the sniper entries as well. We use this in alignment with the lower time frames to tell us exactly, to give us a higher probability trade. Now, this is gonna be our previous high of day right here. And then now we go into the higher time frames. We're going to start on the weekly. We're going to turn this off right here. So we're going to replay right here. If we're trading New York session, this is what we're presented with when we come to sit down to trade in the market. So now we go to the weekly time frame. We turn off the session-based indicator and check this out. It seems, well, it doesn't seem, price is obviously giving a pullback, right? We have a big distribution to the upside. Price is breaking all-time highs, and the market has to give pullbacks at some time, right? Now, the higher time frame pullback, which is going to be the weekly zone, is going to be this one. This is the first weekly demand. So check it out. Price gave this big distribution to the upside. This is our weekly demand right here. The previous contrary candle before a big push. So this is the previous contrary candle before this distribution. We're going to go to the daily. And I'm not going to mark another weekly demand because first we got to work with these zones here. But honestly, just so you guys get the point of it, you could go ahead and mark this. This would be the next weekly demand. But we're not going to have a bunch of lines on our graph. I don't want to confuse you. So now we go to the daily time frame, and you guys are going to see something here that is key. What do you see? The weekly and the daily have an area of demand to the exact tip. I can't even mark it because you won't see it. Look at it right there. That is the daily demand in confluence with the weekly to the exact tip. This candle right here. Previous contrary candle before the distribution. But we could mark something else. We could mark this one right here. This is another daily. We could mark this one, which is going to be a target before we reach this one. And we could obviously mark this one here. This one is a daily demand. So this was the first target for this morning right here. We're going to mark this as daily. We're going to go to the H4. Check this out. Now, in the morning in pre-New York session, price hadn't hit this area yet. So this was going to be the first target for New York session. And you can see how it makes sense. This is obviously where price is going to, the daily demand. And once we break past this area, price will then go to the next zone right here. So the next candlestick is going to be this one right here. So actually we have this right here. We have the H4 and the daily. These are the targets for this morning. Once price breaks past this area, this is the next target down here. And we could mark this one here. Now, I know you guys are probably confused as to why I'm marking this one as a H4 demand. You guys are probably like, oh, it's touched, but it is not touched. This is volume leaving the area. So previous contract candle and distribution to the upside. If this was a bearish candle pulling back into this area, then it would be considered used. So if this candle right here, would have pulled back into the area, then it's used. But since price did not pull back into it and it's just volume leaving it, it is valid. So we have our higher time frame targets. Then we can also mark this right here, H4 supply. We can mark this one, and we'll mark this one. And obviously the true supply is the one all the way up here, but we don't want to mark a bunch of lines. We just want to mark the most relevant areas to us. So now we go to the H1 time frame. What do we see on the H1 time frame? You could see that price created an area of supply right here. Area of supply, H1. And we also have an H1 right here in confluence with H4 and the low of day. So high probability area for price to sell from at some point. So when price starts to come up, we might see a sell movement off this area, at least a pullback. Now check it out. If the higher time frames are telling us to sell, right? The higher time frames are telling us to sell, and they're letting us know that our targets are over here. So price is at 2635 and our target is about 100 pips away. Now check this out, guys. There is multiple ways that I get my entries, my sniper entries. Check it out. I'm gonna explain the first rule for you. So notice this is an M15 supply, and this is from our previous session. So it's actually right here. Sorry about that. So notice M15 supply from our previous session. If we're trading New York session, previous session is pre-New York. If we have multiple time frames in confluence, so for example, we have an M5 supply, and we also have an M15 supply, and we also have an M5 supply in confluence with it. So look at it right here, M15 and M5 in confluence. We can even go to the M1, and you'll see that we have an M1 in confluence with it as well, which is going to be this one right here. I can't mark it because it's coming from the exact same area. So look at the M1 in confluence with M5 to the exact pip, in confluence with M15. Now, what does this mean? This means that this is a high probability area to sell from if price were to pull back all the way over here. But seeing how far price is away from here, notice this is the target here, 100 pips. It makes no sense for price to pull back 300 pips to then continue to this target here. But this is obviously a high probability area if price were to pull back into it. Okay, so notice, if price is not likely to pull back all the way over here to hit our target, what's the higher probability chance? For price to create a new area of supply in our current session to then sell, being New York session. Now notice, on M15, we have nothing to work with, just one big distribution. So we go to the M5, and what do you see on the M5? You can notice that price is coming off this area of supply right here. Nothing too crazy, but it is an area of supply. So we'll just mark this like this as supply. We go one lower time frame, M1, and we're gonna trade off of the M1 once we have our zones marked on the higher time frame. So you could even mark this like this. Now we go over here. Actually, let me delete this. Now we go over here and we fast forward a bit. What did price do right here? Check this out, guys. So actually, let me go back. Price is coming off of the M5 supply and then creates a new M1 supply right here. So check this out. M1 supply. That's why it's important to use every single time frame. And notice, M1 supply, price creates a push, a distribution of about 30 pips. So this is a solid distribution right here. Now, what does this mean? This means that New York session, if you notice, is a previous contract candle, and then the volume that created the supply is coming from New York. So if the volume is coming from New York, that means New York session created this area of supply. Now, the key rules to enter in the market is it can be multiple time frame confluences from your previous session. If they set you up, you just place a buy limit, sell limit from that area, automatically take the trade. Like for example, over here, if price were to pull back, you could automatically take the trade. But in a case like this, you needed price to create the supply in your session to sell from, and it did right here. So obviously right here, you could place your sell limit, and you work with something like this, about 30 pips, 30 pips, 32 pips, and we could go to, we'll hold this one. Now check this out. Price pulls back to the exact area of supply right there, and then you can see that is where the volume comes and the distribution comes. Check this out. Boom, right there. Main target that we were talking about, smashed. Perfect trade. This gave you a perfect 1 to 3. You don't need anything more than this. Now, I know some of you guys are probably asking me, why would you take the trade off of this M1 supply if it's by itself? It doesn't have an M5 or an M15 in confluence with it. The M1 time frame is the only time frame where you could take a trade from if it's by itself from your session or your previous session. That is a valid area. So what do I mean by this? I mean, if you have an M1, so actually let's go to a random chart to show you exactly what I mean. GBP, NZD, just something random so I get a fresh graph. So for example, if you have an M1 supply right here that creates the distribution, mark that wrong, M1 that creates a distribution, so you have something like this, M1 supply, that is valid enough for you to place your sell limit right off of this zone with no entry confirmation needed. If it's from your session or your previous session, meaning it cannot be from 3 or 4 sessions ago, it has to be from your session or your previous session. And then price would pull back up to this area and it will look something like this. That is valid. Now, that is the M1 time frame. Now, if you have a let's actually delete this. If you have a M5 supply, for example, from your session or your previous session by itself with not an M15 or an M5 or an M1 in confluence with it, meaning if it's by itself like this and not like this, so check this out. M15, M5, as long as it's a few pips away, it doesn't have to be exactly, as long as it's in the 10 pip range, it's in confluence. Now, sometimes it's going to be the M5, the M15 above, as long as either way they're in confluence. So if you have multiple time frames in confluence, you could take the trade from that area automatically, no entry confirmation needed. But if you have an M5 supply or an M15 supply by itself, with no M1 in confluence with it, no M15 in confluence with it, or if you have an M15 by itself like this, with nothing else in confluence with it, you need an entry confirmation off these zones. Now, what's an entry confirmation, guys? An entry confirmation is a lower time frame supply created off of a higher time frame, meaning you would need something like this. You would need price to reach the M5 area and then create a new area of supply, which would be right here, something like this, M1, and then this would be your trade right here. Something like that. Now, enough showing you random parts of the graph and random explanations. Anyone could do that, right? And be like, oh, this strategy works. No, I'm going to show you an actual trade that I use, breaking down the strategy that I just taught you, and I call this in the signal group, giving us a 1 to 3 risk to reward. Now, this is actually a little bit of a complex trade because we needed an entry confirmation off of a zone. So I think it's going to be a great example to break down. So check this out. This trade is coming from October 24th, New York session. So what did I tell you guys? I told you guys that our first thing to do is obviously we're going to be dealing with this. It's 8:35 in the morning, and this is what we're presented with, right? 8:35, and we trade at 9 a.m. So if this is what's presented in the morning, you guys know that the first thing we do is mark the high and lows of days, which I'll get into that in just a second. It's going to be this area. It's going to be this area right here, the high of day. It's going to be this area right here, the high of day, the highest point between Frankfurt to New York session. So we'll go ahead and mark this as the high of day. And we're going to go ahead and mark this as the low of day. Now remember, guys, I know some of you are probably asking, why are you marking this as the low of day and not this if this point is lower, than this? The reason is because this is the lowest point in session. This is out of session. It has to be between Frankfurt to New York session. Asia session does not count, and it cannot be out of session. So we have our high of day, low of day. Now we need to mark the previous high and previous low of day, which is going to be 2 previous trading days. So we'll go ahead and mark this right here, previous high of day. And we're going to go ahead and mark this right here as the previous low of day. Now, what's the next step that I told you guys? We're going to go on the weekly time frame and do a top-down analysis, working our way down all the way to the M1. So check this out, guys. If price is right here, right off the bat, what could we identify? Price is giving a bearish pullback. We have this right here, which is a weekly demand. We're going to go ahead and mark this right here. Weekly demand. I actually think price tapped it already, but it probably didn't tap it before. So I'll show you exactly what I mean. So it looks like it tapped it here, but once we replay, it didn't tap it yet. This is going to be a target. So we have this here, and the next weekly demand would be coming from all the way over here because this area is touched. All these areas are touched. So we're not going to mark this all the way down here because this is just too far away and it's not relevant to current price. So what is relevant on the weekly time frame? This weekly demand, and we could even mark this weekly supply. Weekly supply. Now we're going to go ahead and go to the daily time frame, which is the next time frame. And check this out, guys. Here we have a daily supply coming over here. Daily. Mark this right here. And then what do we have here, guys? Let me zoom this up a little bit. Price actually touched the weekly demand. In this case, actually, let me see before I get ahead of myself. Yes, it did. Yes, it did right here. So look how price tapped right here to the exact pip. I'm telling you, this is the most precise way to mark supply and demand in the market. Look how price tapped the weekly demand, and price is giving a bullish move off of it. So actually go back to the daily. And what I wanted to point out was that there's no daily demand. Notice how this was a daily demand right here, but price pulled back into it here. So distribution, price pulled back to the daily demand, and look at the volume coming off of it. So if price is coming off of this weekly demand, that means more than likely price is finding supply. But we're gonna go one lower time frame, and we'll mark the next area of interest, which would be this one here. So if price breaks past that weekly demand, this would be the next demand that price would head to, this one here, and then this one down here. Actually, it's this one. No, that one's touched. This one right here, H4. Remember, guys, this is not pulled back into by a bearish candle. This is just bullish volume leaving the area, creating the area of demand. So check this out. The higher time frames are telling us that price is coming off of demand, finding supply. Now, what do we have here? We have a H4 supply right here, which seems to be the first target for price. So we're going to mark this as H4. And we can even mark the next target for price, which would be this one up here. H4 up here. We go to the H1, check this out. What do you guys notice? We have an H4 and an H1 supply in confluence, so it's going to be right here. H1. Why do I mark this candlestick, guys? Because this is the previous contrary candle before a distribution. This area is touched, this area is touched, so these zones are not valid. Actually, my mistake. This area is not touched. It seems like it's touched, but it's not. So this is actually the next target. So H4 and H1 supply up here. Now, check this out. We go to the M15, and this is where the sauce comes in, guys. So the higher time frames are telling us we're coming off of demand, finding supply. First target is going to be this one right here. So first target for price is going to be this H4. And once we break past this area, we will head to the next supply, which would be this H4 over here. And once we break past that area, the next target would be this H1 over here. That is how you find market direction, guys. This is a little key right here. So I'm just giving you a little bit off topic, but this is sauce. So how do you know where the market's going? It's going to wherever the market breaks. So if, for example, if the market breaks supply, it needs to continue to find supply. If it respects supply, then it needs to find demand. And you can see right here, the price is coming off of demand, now it needs to find supply. So what do we have in the M15 time frame? We chart out our session-based indicator, and we have a nice M15 demand right here coming from London. So we'll go ahead and mark this right here. M15. We go to the M5. We have an M5 demand over here. So these are two areas with an entry confirmation. Why do we need an entry confirmation of these areas? Because they are not in confluence. So these are two areas where you could enter with an entry confirmation. Now, let's fast forward just a little bit. Boom, what does price do right here? New York session opens and it gives a distribution. So price created an M5 supply right here, right? An M5 supply in our session, but let's see if we have anything in confluence with it. We go to the M15 and we do not have an M15 in confluence with it. No, check this out. Now we go to the M1 and we do not have an M1 demand in confluence with it either. So what do we need off this area to enter? We need an entry confirmation, which will look like this. We need price to come back here. Actually, and do something like this. Boom. Now check this out. Once I have my area marked here, the M5, I wait for an entry confirmation on the M1 off of it to buy. Now check this out. Boom, price taps the area. Okay, perfect. So boom, check this out. Price taps the M5's demand. And what does it do? This candle right here, when it closes, we're gonna have a void right here to fill, and price is creating an area of demand off of it, which is our entry confirmation. So M1 demand created off of the M5. I sent a buy market execution. Actually, I'm not sure if it was a market execution or buy limit. It might have been a market execution due to how fast price, yeah, market execution due to how fast price pulled back into it. But I literally sent it when price was at the area. So everyone got the same entry. And this is what we are working with right here. So check this out. 10 pip stop loss. And obviously this is our first goal for the morning, but we have our main targets over here. Actually, but we have our max TP over here. So this is the first target for the morning, the H4 supply. And then obviously once price breaks past this area, these are the next targets for price. So notice, we just need price to pull back into this area and we could buy. Now check this out. Boom, price pulls back into it with the next very candle. And check this out. Let me spread this out. Look at this. Notice how we're in profit and the volume is coming off this area. We're a little bit of drawdown, profit. It's okay. All right, let me zoom this out. I didn't think price was going to take so long. So check it out. This is all noise. Price is just in consolidation, but we got our entry confirmation on the M1 time frame, and look at the volume coming off. Price hits the first target, and then we hit final TP over here. So final TP, which looks like this. Which looks like this. This right here are 1 to 3. Let me go to the 5, so this speeds up a little bit. This is taking a little bit too long. All right, perfect. Look at our trade right there. Perfect, 1 to 3. Now you guys just saw how I broke this down from the weekly time frame all the way down to the M1. How did we enter this trade? We analyzed that the market is coming off of a weekly demand, needs to find supply. First target for price was this H4 right here. What is the lower time frame telling us? That price created an M5 demand in session, but there is no other time frame in confluence with it. So if there's no other time frame in confluence with it, we need an entry confirmation off the zone on the M1 time frame. And look at it right here. Price taps the M5, gives the distribution, we pull back, and that is our entry right here. And notice how we went into a little bit of drawdown, but then price smacked our take profit. Now you guys just saw why they call me the Signal King. I broke down exactly how to find the market direction on the higher time frames, how to get the most precise entries on the lower time frames, which a lot of people are afraid of the M1 time frame, but I just showed you how to navigate, use it to maximize your profits. Now, make sure you guys like this video and subscribe, because I'm gonna be uploading a lot of free content, at least 4 videos a month. The goal is 8, but we're definitely gonna be doing at least 4. Now, I do not have a course, so basically everything that I know and I use on a day-to-day basis to have a winning streak, which is my longest winning streak was 23 weeks last year, I give it to you for free. So take advantage of this content. I promise you, no course that you buy out there will have this quality of information, and it's free. So make sure you like and subscribe.